Hi, great presentation.
Thank you.
I have three questions.
So your name?
Cedric.
Cedric, yeah.
Yes, I have three questions. In terms of how would you calculate the tops and the bottoms? When I was listening to your presentation, I was thinking about pivot points, but I think you mentioned through cycle analysis. Just wanted to confirm. Did you look at the distributions? Second question, did you look at the distributions of, for example, the pound US, the pound to the US dollar, if any of those, if the returns, the past returns followed any sort of distribution, like a log normal distribution or Poisson distribution or anything? If you guys check that, just out of curiosity. And third one, what trade in July, what trade or trades in July, I mean, if you're able to share, pull you out of the negative drawdown?
Oh, yes, yeah, definitely I can. Thanks for the questions anyway, yeah, really like that. So Cedric, I'll take it one by one. I'll make sure as much as I can remember or remind me the questions. So the first thing you asked was on the tops and bottoms, right? How would they calculate it? Firstly, so the guys developed some mathematical formulas, okay, to calculate the tops and bottoms. So it's not based on pivot points or whatsoever. So it's purely mathematical formulas. But the usual question that comes after that is for quite a few years, I just took it as it was. But this question came to me as you go deeper is, what makes those formulas better than anything else? Because you guys can come up with your own one tomorrow. You can just say, as long as it travels 100 points from the bottom, that's my confirmed bottom. And you can make up your own open equity table and all of that, right? So how do you know which one is better than the other? Does anybody know the answer to that? How can you say one way of calculation of a top and bottom is better than, let's say, Rob's way or Jeff's way of calculating or Olivier's way of calculating the tops and bottoms? How do you think we can do that? Yeah, what part of the stats can we look at? Which stats?
The average return over time.
That's on a strategy, right? But everybody's strategy construction can differ. They're just purely talking about whose quantification of top and bottom is better. And you know what the good thing about quants is? They never give you a wishy-washy answer. It is so precise and it's logical. And you know what my mentor told me? And immediately, just in one word, he said, the way to see which calculation is better, you compare A and B and C or whatsoever not, see which one produces the largest open equity. That means, in other words, if I want to be a bit more specific, when you look at the open equity table, basically, if your way of measuring, this time I got it, right? If you look at the open equity, let me see, just quickly bring this up. This one, I'll just leave it there as well. Let me bring up that. So the way to see which one is better, so this is, we just call it MasterTheMarkets way of looking at the open equity. If you guys develop, so let's say Cedric, you develop your own way of developing open equity, the main numbers I will look at is the 50% mark. My thing produces 150 pips. If yours is better, your 50% mark should be more to the right or the left. Which one should it be? More to the right or the left? To the right, isn't it? Yeah, it should be more to the right. Your 50% number should be bigger. But if it's not good, your 50% number will be more to the left. Let's say yours only will produce 50 pips. Logical, right? And that's how quants always answer the questions. Very precise and very logical when you think about it as well. So, okay, that's your first question. The second question was, you were asking me, is the distribution part of it, right? Yeah, so far my memory is good. So the distribution part of it, what we found usually in strategy construction, not necessarily in open equity data, we've not gone that far. What we have usually seen is that November and December are not the best months, right? So what we usually do, and we've seen that in over 10, 15 years of testing, maybe because the volume drips off away, maybe the runs are not that great, I don't know what it is. Just generally we have seen, mainly in Forex we've seen that, but when we looked at other instruments, we've seen that too. So what we usually do because of that, November and December, if you look at all our equity curves, usually November and December are very low, we usually put lower risk, usually on all our trades. Most of the money is made, usually we have seen, in the first 6 months. That's where the heavy profits come. The last part of the profits usually come in September and October, right? Even though we're not really seeing that this year as well. So that was the second question, right? And the last one was, remind me?
What trade or trades pull you out of the negative?
It was the 20. It was the TSL primary trades over here, which are more longer running trades. And like you know, I'm with the third strategy over here. Yeah, this one should come up. Oh, you're looking at 2023. So this one over here in June, right? 8.86 came from the TSL primary strategy and from the lift of 20% open equity. What are we looking to do here? We are waiting for the big runners, right? So the whole idea of the strategy portfolio is so that while I'm waiting for the big runners, the other strategies take, especially the one-day exit, will take for me some good amount of profits in the time being to minimize my overall equity drawdown. But this year it hasn't done that great because we altered the framework a little bit. We reviewed it. But 2022, it did really very well on the one-day exit. But in answer to your question, it was the big runners, which is usually, that means in the open equity table, I'm looking at the 20% runners over there. Okay, yeah. So you got to have a lot of patience for that. Also, understanding the stats will give you patience as well because you know that only 20% of them will get there. So you have to wait for them. Okay. Right. And so you at the back, you had a question? Yeah. Oh, you asked it already? Okay, you jumped the queue. Yes. The journalist.
Could you tell us the name of your mentor and of his mentor, please?
Yeah. One thing is that they don't want to be named. So sorry, so I can't really answer that. I've asked them before and they said they would like to be anonymous. In fact, my mentor's book as well, it created a lot of big billionaire hedge fund traders. But because they didn't want to dilute the knowledge, they took it even out of circulation. You won't be able to buy it anymore from any bookstore.
Very unusual.
Thank you. Yes.
May I ask the name of the book?
The book that my mentors, I can't say that on the record. We can say over drinks maybe.
Okay. The other question I have is, what would be an acceptable drawdown for you?
The maximum drawdown we usually go for is about 15 to 20%. 20% is where we call it max. And then we'll stop the strategy at that point.
Thank you.
Yeah. So for the one-day exit or maximum drawdown, sorry, before the one-day exit, which we stopped it around June this year, the maximum drawdown for that in all our testing over 10 years was about 12%. So when it overrode that and came to 15% is when we stopped it and we reviewed it and we did a video on that as well on our channel and all that as well. Sorry, yeah, the question.
So you mentioned 20, 50, and 80%?
10 to 15.
20, 50, and 80% of open equity.
Open equity.
Yes, which will go into like your selection of the strategy and parameters. But this percent, they depend on the historic data, right? So if today 80%, that's, I don't know, 275, months later, that might be completely different number.
Mm-hmm.
How often do you review parameters based on the change in history?
You see, the good question, I thought you were going to ask the other one, which is quite popular, but I'll answer that as well on top of this. One thing is, how often do you change the data? If the data sample is quite large, usually you don't need to change that very often. It doesn't really change. It can't change by tomorrow. It can't change by next month because we are selecting this over 13 years of data, right? So it's quite a large data sample. But still saying that, especially for instruments like crypto, right? I mean, forget about raw distance, forget it. I mean, today it will tell you 5,000, right, points, and tomorrow it might be 20,000 points on an average. So for that, that's why we got the ATR built into that, right? When you use ATR, the average true range, is a volatility-based measurement, then it will smoothen the curve on. So you can use that as well. So that's why when we construct our strategies, we look at both. And one of my other clients, he likes to use the percentage because he's more an investor. Remember in the beginning when I started this talk, I said all the things I'm going to show over here is cross-transferable. So some of this you can also use for investment purposes too. And we got some guys both from Gavin's database and ours who use it for investment purposes. That's the first part. If I want to add on to your question, and I think Olivia, you asked me this before as well, which is, what is the validity of this data to reproduce? right? So one thing is how often do I need to change it? But that leads to the second question, which is reproducibility. As professionals, we need to think that, right? Even if you don't ask me that, because we're trading with real money, we will ask that to ourselves. Why must this continue to work? And it's one of the biggest important questions that actually has built the biggest hedge fund in the world. Ray Dalio, Bridgewater Associates, he always says, ask this question continuously. It's not an easy question to answer. Why must it continue to work? There's really three reasons why this will continue to work. One is first, okay, the large data sample will enforce its reproducibility. But even that, for a mind like me, that's still not satisfiable answer. The second thing that will ensure its reproducibility is the way in which the data was derived, which is by locking in the point of entry and maximum point reached, which is a structured framework from a top and bottom movement. And why is the top and bottom movement so important? Because you're going into the nature, the core in which markets move. Whichever instrument that you pull up, it's got to move in cycles. Because why? It cannot move in a straight line. That's the second reason that gives me confidence in the reproducibility of this data, the way in the data was derived, right? The third thing that gives me the confidence in this is because, to go back to the second point, from which it's the way in which markets move. They move in cycles. If you're not able to construct a good strategy that reproduces, and especially if you've got a liquid instrument, you know that some of those bottoms and tops are going to move in trend. If they don't move in trend, how else can they move? So then it comes in terms of your selection of those swing moves. How good are you? How good is your skill? What other indicators are you going to combine with it? Are you going to combine volume? That's why we partnered with Gavin and his team, Trade Guider. Are you going to use Fibonacci's along with it? Because this, you can pile anything on top. Stochastics, you can. RSI, you can, anything. And you can automate it too. And you can apply a bit of discretion. That's the third part to it, because of the nature in which this framework was developed. But even then, all these three things may not satisfy somebody. And how do you still then overcome that doubt that you may have? Is by monitoring your results, which is what we keep doing. Right? See if it keeps overcoming your maximum drawdown. Okay. That's how I'll answer that. Yeah? Hopefully. Anything else? Oh, okay. Probably the last one, isn't it?
Yeah, hi. I'm interested to know, I'm assuming with this you only have liquid instruments. So
correct.
So how do you judge going down? Do you take individual equities? Do you do it on commodities?
Yeah, we actually do it on 10 instruments. I think you guys actually take a look at more, isn't it, actually, Gavin? They actually take a look at more. But you can do this on any instruments as long as there's movement, of course. There's volatility, there's liquidity in it. We take a look at specifically currencies. We look at equities. We look at commodities like oil, gold, silver. We've done a lot of trades on gold and silver, me and Gavin. You can also take a look at indexes. We take a look at Dow Jones quite a bit as well. S&P, anything you name it. I mean, the liquid ones you can. In fact, I'll tell you one side point. I know you got probably an extension of the question. In my mentor's book, when I read this, and in fact, other clients have told me this, once you find the instrument that really works, there was one guy who found it really worked, and he never shared that instrument with anybody else. Once you got your diversification portfolio, just don't share it with anyone, you just keep it to yourself. But the real trick is in finding the instruments, the diversification of your portfolio.
Okay. And you mentioned equities. So how do you make a difference between high dividend stocks and non-dividend stocks? Because that can influence people's minds and about, do they want to take the dividend and then they come out and when the dividend's paid, it goes ex-div. And do you go into that kind of detail?
I mean, we don't go into too much detail. If you look from a statistical point of view, the dividends is a secondary thing, right? Yeah. It will come down to how that person's portfolio wants to look like. Is he looking mainly for cash flow, or is he looking for more capital growth in the long run? What is more priority? I mean, the best way to balance this out is have one strategy portfolio, where it's just based on capital growth. Have another one which is based on cash flow purposes. And when you're looking at cash flow purposes, of course, the game gets a bit more tougher. And then you've got to start looking at all the stats. And if you can couple that up with dividends as well, why not?
Okay, that's interesting. I'll probably ask some questions later on. Some other questions. Thank you very much.
Do you have time for one more?
Does this only work on the daily time frame? Do you use
No.
other time frames?
You can actually look at it on all time frames. It's good that you asked that. You can even go as low as some of Gavin's traders and look at 1 minute time frames. Yeah, look at ticks as well. So you can apply to anything. In fact, I tell you one last thing, and we can probably wrap up. Probably no questions. Is the largest open equity, the biggest moves with the smallest average loss is actually derived when you combine time frames. Because I'll leave you with this thought, and then we'll go into drinks, is remember that what you're seeing there, a daily bottom or a top was once a 1 minute bottom, which held and became a 15-minute bottom, which then became a 1 hour bottom, 4 hour, daily, weekly, monthly. And when you keep thinking like that, you know what, when I read that line in the book, that's what blew me away. Because that's where the real money is. When you can identify those, or we can call it ripple to swell to wave, a tsunami, right? But can you capture it when it's just forming? And how good is your skill combining everything that you have learned in your STA diploma and in your ongoing knowledge, and with this now today that I've shown you. All right?
Very good.
Thank you, guys. Yeah?
Thank you so much.
Yeah, just in case, I know some of you might be thinking, where can you find out more, right? Just remembered. Everything that I just mentioned is actually on this one here, traderstarterpack.com. So when you register there, you will get the other video series, which will enhance all your entire knowledge, and you can revisit it as many times as you want. Okay? That's great. Thank you, guys. Yeah, see you at the drinks. Thank you, no problem.
If you want to get notified every time we put a video up, especially on our live trading update videos, hit the subscribe button and turn on the bell notifications icon. This will get the YouTube algos to kick in and for you to join us in our mission to spread the truth of trading further so that traders like you can benefit from our videos to trade like a master, achieve consistent performance, and change lives.